Imagine a scenario where the two largest economic superpowers on the planet are simultaneously negotiating massive trade deals while preparing their respective military and technological infrastructures for a complete and total decoupling. This is not science fiction. This is not a hypothetical war game played in a secure basement. This is the exact reality of the global market this very second. The money in your retirement account, the cost of the goods you buy, and the long-term stability of your wealth are currently trapped in a crossfire of shifting global alliances, escalating energy wars, and internal political fracturing. Hello, this is WarmInsight. Today, we're going to talk about geopolitical crosscurrents and domestic policy shifts. Leaving a like and subscribing is a huge help to us to truly comprehend the magnitude of the current geopolitical landscape and its direct impact on your financial future. We must first strip away the daily noise of the news cycle and examine the deep historical currents that are driving the actions of nation-states. The global economy is currently dominated by two intertwining narratives that are reshaping the very concept of risk. The first and most consequential is the shifting power dynamic between the United States and China. When President Trump arrives in Beijing, accompanied by key corporate chief executive officers, it is a moment of profound historical weight. This summit is not merely about trade tariffs or agricultural exports. It is a fundamental renegotiation of the global operating system. To understand this, we must look back at the historical philosophy of international relations, specifically the concept known as the Thucydides trap. Ancient Greek historian Thucydides observed that when a rapidly rising power threatens to displace an established ruling power, the resulting structural stress almost inevitably leads to severe conflict. For the past several decades, the United States has been the undisputed global hegemon, enforcing a system of free trade and open sea lanes known as the Pax Americana. This system allowed for unprecedented global economic growth, lifting billions out of poverty. By integrating developing nations into a massive, highly efficient global supply chain, China was the greatest beneficiary of this system, specifically after joining the World Trade Organization in 2001. The Western world operated on the assumption that economic liberalization in China would naturally lead to political convergence. That philosophical assumption has now definitively proven to be incorrect. Instead, we are witnessing the emergence of two distinct, competing spheres of influence. The presence of figures like Jensen Huang of NVIDIA at this summit underscores the absolute critical nature of this new competition. We are no longer fighting over territory or gold. We are fighting over silicon, artificial intelligence, and the architecture of the digital future. Semiconductors are the oil of the 21st century. Whoever controls the design and manufacturing of the most advanced microchips will control the future of military supremacy, economic productivity, and global communication. Therefore, when you see a bipartisan push from Michigan lawmakers to ban Chinese connected vehicles, you must understand that this is not a simple protectionist measure to save domestic auto manufacturing jobs. It is a profound national security maneuver. Connected vehicles are essentially massive rolling computers that map infrastructure, gather geospatial data, and communicate with critical networks. The fear that foreign technology has become a modern-day Trojan horse is driving a rapid fragmentation of the global supply chain. This is the end of the era of globalization that prioritized cost efficiency above all else. We are entering the era of the fortress economy, where national security dictates trade policy. For the everyday investor, this means that the old, reliable strategy of investing in massive multinational corporations that rely on frictionless global trade is now fraught with hidden dangers. The geopolitical balance of power is perceived to be shifting in Beijing's favor, suggesting that the United States may be negotiating from a position of reduced leverage. This has massive implications for intellectual property rights, currency stability, and the long-term profitability of companies. Caught in the middle, the smart money, the institutional contrarians, are not reacting to the daily headlines of the summit. They are deeply analyzing how companies will survive and thrive in a bifurcated world, where they may be forced to choose between access to the American financial system and access to the Chinese consumer market. Simultaneously, a second, equally dangerous narrative is unfolding in the Middle East, casting a long and dark shadow over global stability and energy markets. The looming potential for a broader conflict involving Iran is not just a regional political issue. It is a systemic economic threat that affects every single person who consumes energy or buys transported goods. To grasp the psychological and economic terror this inspires in the markets, we must travel back to the defining economic trauma of the 1970s. In 1973, the Organization of Arab Petroleum Exporting Countries instituted an oil embargo against nations that supported Israel. During the Yom Kippur War, the result was not just an inconvenience, it was a structural shock that altered the trajectory of the global economy. The price of oil quadrupled almost overnight. Lines at gas stations stretched for miles. But the most devastating impact was the birth of a phenomenon known as stagflation, a terrifying economic condition where high inflation combines with stagnant economic growth and high unemployment. Prior to the 1970s, mainstream economic theory dictated that inflation and unemployment were inversely related. The oil shock destroyed that theory and proved that geopolitical events can break the fundamental mechanics of the domestic economy. Today, we are seeing crude oil hovering around $85 a barrel, and the trend is pointed stubbornly upward. This elevated price is not merely a reflection of current supply and demand. It is heavily weighted by a geopolitical risk premium. The market is pricing in the fear of the unknown. They are pricing in the possibility of a disruption in the Strait of Hormuz, a narrow waterway through which roughly 20% of the world's global oil consumption passes. If that choke point is compromised, the resulting supply shock would send energy prices skyrocketing, acting as an immediate and massive tax on every consumer and business on the planet. This is why the internal political dynamic within the United States is so heavily scrutinized by global capital markets. The growing bipartisan opposition in the Senate to the president's war powers is a fascinating psychological study in institutional hesitation. The tension between the executive branch and the legislative branch over the commitment of military forces has existed since the drafting of the Constitution, but it reached its modern form with the War Powers Resolution of 1973 ironically passed during that same era of global instability. When the markets observe this internal dissent, they do not see a healthy democratic debate. They see a vacuum of decisive leadership. Markets possess a collective psychology that can adapt to almost any known reality, whether it is a state of peace or a state of war. What the market absolutely cannot tolerate is ambiguity. Ambiguity aversion is a well-documented behavioral finance concept, where investors demand a higher expected return to compensate for risks that are difficult to quantify. When the government is divided on foreign policy, during a global crisis, ambiguity spikes, causing investors to pull their capital out of productive assets and seek the safety of cash or government bonds. This is why we see the stock market moving sideways. Despite seemingly strong corporate earnings, the herd is paralyzed by indecision, waiting for a clear signal of where the ship of state is actually steering. This brings us to the engine room of the global economy, the Federal Reserve, and the critical implications of domestic monetary policy shifts. The Senate's confirmation of Kevin Warsh as a Federal Reserve governor is a development of monumental importance that the average retail investor completely overlooks. To understand the gravity of central banking, we have to recognize that money is not an objective physical reality. Since the abandonment of the gold standard, money is entirely a psychological construct, backed by the full faith and credit of the issuing government, and managed by the central bank. The Federal Reserve has a dual mandate to maximize employment and stabilize prices. When inflation threatens the economy, the Federal Reserve uses its primary weapon, the federal funds rate, to cool down economic activity. By raising interest rates, they make borrowing more expensive for corporations and consumers. This slows down hiring, reduces consumer spending, and eventually forces prices down. However, this is an incredibly blunt instrument that inflicts real pain on society. Kevin Warsh represents a potential shift toward a more hawkish ideological composition within the central bank. In economic terminology, a hawk is a policymaker who prioritizes fighting inflation over maximizing employment, often favoring higher interest rates, even if it risks causing an economic recession. This philosophy harkens back to the era of Paul Volcker, the legendary Federal Reserve chairman who took office in 1979 to break the back of the double-digit inflation that had plagued the 1970s. Volcker raised interest rates to unprecedented and agonizing levels, pushing the prime rate above 20%. This caused a severe recession, bankrupting farmers and businesses across the country. But it ultimately succeeded in restoring faith in the United States dollar and setting the stage for decades of stable economic growth. When the market sees a hawkish figure like Warsh gaining influence, they immediately begin to reprice the cost of capital for the entire future. If interest rates remain higher for a longer period, the mathematical present value of future corporate earnings decreases, which puts downward pressure on stock prices, particularly in high-growth sectors, like technology that rely on cheap borrowing to fund their expansion. Furthermore, the administration's push to involve the Internal Revenue Service in immigration enforcement signals a period of highly aggressive and potentially disruptive domestic policy implementation. It shows a willingness to leverage every single instrument of state power to achieve ideological goals, regardless of the institutional norms that are broken in the process. For the investor, this means the regulatory environment is becoming just as volatile and unpredictable as the geopolitical environment. In this exceptionally complex landscape, the divide between the retail investor and the institutional investor becomes blindingly obvious. Retail investors, often driven by immediate emotional responses, and the relentless drumbeat of sensationalist media headlines, are trapped in a cycle of reactive panic. This behavior is perfectly explained by prospect theory, developed by behavioral economists Daniel Kahneman and Amos Tversky, which demonstrates that humans experience the psychological pain of a financial loss much more intensely than the pleasure of an equivalent gain. When a retail investor reads a terrifying headline about a failed diplomatic summit or a military skirmish, their evolutionary survival instincts kick in, triggering a flight-to-safety response that causes them to sell their assets at the exact wrong time. They are constantly reacting to the ripples on the surface of the water, entirely blind to the deep structural currents moving beneath them. The institutional contrarian investor operates on a completely different psychological framework. They are the seasoned captains, navigating the supertanker through the treacherous strait. They understand that while the winds of the daily news cycle are shifting unpredictably, the fundamental laws of global economics remain constant. Instead of panicking over the potential failure of the Beijing summit, the smart money is analyzing the long-term necessity of supply chain resilience. They recognize that the era of relying on a single, politically adversarial nation for critical manufacturing is over. This means that massive amounts of capital must be deployed to rebuild industrial capacity closer to home, a process known as reshoring or nearshoring. Therefore, the contrarian investor is not fleeing the market. They are strategically accumulating positions in the domestic industrials and materials sectors that will benefit from this generational shift in manufacturing infrastructure. They are looking at the escalating tensions in the Middle East and the shifting defense postures around the world, and they realize that global military spending is entering a secular bull market. In a fragmented world where the protective umbrella of the United States military is no longer guaranteed, sovereign nations must drastically increase their own defense budgets. This transforms aerospace and defense contractors from cyclical bets on specific conflicts into foundational, long-term growth assets. The smart money also understands that the modern battlefield is no longer confined to physical geography. The invisible war of cyber espionage, intellectual property theft, and critical infrastructure hacking is raging 24 hours a day. Cybersecurity is no longer an optional information technology expense for corporations. It is an absolute survival requirement, mandated by boards of directors and national security regulators alike. Therefore, how do you protect your wealth and actually profit in a world dominated by fear and political volatility? The answer lies in the Titan's playbook, a framework of emotional discipline and rigorous asset allocation. The current market sentiment is heavily skewed towards apprehension, requiring a distinctly defensive posture. You cannot simply buy a broad index fund and expect the frictionless growth of the past decade to continue. You must actively construct a portfolio designed for resilience. We recommend a strict allocation model of 50% diversified equities, 35% safe haven assets, and 15% cash. The equity portion must prioritize companies with unshakable balance sheets, high profit margins, and the ability to pass inflationary costs onto the consumer without destroying demand. These are found in sectors like consumer staples, healthcare, and utilities. The Safe Haven allocation acts as the shock absorber for your portfolio, utilizing government treasuries that benefit from the global flight to safety during times of extreme panic. But the most important and most misunderstood component is the 15% cash allocation. In an inflationary environment, people often view cash as a depreciating liability. However, in a highly volatile geopolitical environment, cash is the ultimate strategic asset. Cash is a call option on a market crash, when the herd inevitably panics over a terrifying headline and aggressively sells off high-quality assets at a deep discount. Your cash reserve is the ammunition that allows you to buy those assets at generational low valuations. To execute this without falling victim to your own psychological biases, you must utilize the mechanics of dollar-cost averaging. This means deploying a fixed amount of capital into the market at regular intervals, regardless of whether the market is up or down on that particular day. Dollar-cost averaging forces you to buy more shares when prices are low and fewer shares when prices are high, mathematically lowering your average entry cost over time, while completely removing the crippling emotional burden of trying to time the absolute bottom of a falling market. It is the ultimate survival mechanism for the disciplined investor. Furthermore, while the United States market is facing its own severe domestic political fracturing, it remains the cleanest dirty shirt in the global laundry. The depth of the American financial markets, the supremacy of the dollar, and the relentless innovation of its technology sector provide a level of structural safety that is unmatched anywhere else on the globe. However, ignoring international markets entirely is a mathematical mistake. Emerging markets that are rich in the commodities and critical minerals required for the new global energy transition, or nations that successfully position themselves as neutral manufacturing hubs in the new bifurcated trade war, offer the potential for massive outsized returns. The key is extreme selectivity and a deep understanding of the geopolitical chessboard. History is absolutely overflowing with periods of intense geopolitical tension, economic upheaval, and profound societal fear, from the proxy wars of the Cold War era to the crushing stagflation of the 1970s and the devastating collapse of the dot-com bubble. The world always feels as though it is teetering on the edge of the abyss. Yet, human ingenuity, the relentless drive for technological progress, and the fundamental mechanics of capital markets have consistently found a way to adapt, evolve, and ultimately thrive over the long term. The investors who allowed themselves to be consumed by the panic of the moment suffered catastrophic financial losses. The investors who cultivated true insight, who focused on the enduring forces shaping the global landscape, rather than the fleeting noise of the daily news cycle, positioned themselves to build generational wealth. True financial independence is not achieved by predicting the future with perfect accuracy. It is achieved by building a fortress of resilience, maintaining unyielding emotional discipline, and deploying capital with strategic foresight when the rest of the world is paralyzed by fear. You must view these geopolitical cross-currents not merely as threats to your stability, but as the very catalysts that create structural mispricings and historic investment opportunities.